Hello everyone, and welcome back. Today we're diving into a topic that can truly change your life: investing in the stock market. Whether you're just starting out or looking to refine your strategy, this video is for you. Investing doesn't have to be intimidating. In fact, you already have everything you need to succeed: patience, curiosity, and a willingness to learn. So grab a notebook, settle in, and let's get started. Let me start by sharing an inspiring story. Imagine someone who managed to turn a modest investment into extraordinary returns, not through luck, but by following simple principles. For 13 years, Peter Lynch, one of the greatest money managers ever, led Fidelity Magellan Fund to a staggering 2,800% gain. His secret? Not timing the market, but picking the right stocks based on solid research and understanding. The truth is, anyone can do well in the stock market. You don't need a finance degree or millions in capital. What you do need is patience, a little effort, and a framework to guide your decisions. That's exactly what I'll share with you today: a practical approach to building wealth over time. Before we dive deeper, let's address why stocks are such a powerful tool for long-term growth. Over the past 60 years, stocks have consistently outperformed other investments like bonds or savings accounts. Sure, they come with volatility, but history shows that over decades, the stock market delivers impressive returns. Here's the catch: the magic happens through compounding. Let me explain. Suppose you invest $50 a month, earning 6%. After 30 years, you'd have over $50,000. But if you earn 10%, that same $50 a month could grow to more than $1 million. The earlier you start, the better. A 20-year-old investing $200 a month at 10% would reach $1.1 million by age 60. Meanwhile, a 35-year-old would need to invest $800 a month to achieve the same result. Time is your greatest ally. Now let's talk about how to pick winning stocks. The key is to focus on companies you understand. Think about the products and services you use every day. Have you noticed a brand that stands out? Maybe it's a car manufacturer known for quality, or a retailer with unbeatable prices. These observations are clues to potential opportunities. For example, I once bought shares of Volvo after noticing its superior safety features and value compared to American station wagons. It turned out to be a smart move because the company was undervalued at the time. The lesson here is simple: start with what you know, then dig deeper. Research isn't about complicated math, it's about asking the right questions. Are costs coming down? Is there room for expansion? Does the company have a strong balance sheet? Of course, not all stocks are created equal. To make sense of them, I categorize companies into 5 types: fast growers, slow growers, cyclicals, asset plays, and turnarounds. Each type behaves differently, so your expectations should too. Fast growers, for instance, are companies expanding rapidly, often in industries like technology or healthcare. They might double their earnings every few years, offering huge upside potential. On the flip side, slow growers may not excite you, but if priced right, they can still deliver steady returns. Cyclicals, like automakers or home builders, rise and fall with the economy. Asset plays hide untapped value, while turnarounds bounce back from tough times. Understanding these categories helps you build a clearer picture of each stock's potential. One crucial concept to master is the price-to-earnings (PE) ratio. This tells you how much investors are willing to pay for each dollar of a company's earnings. A high PE suggests optimism, while a low PE might indicate skepticism, or a bargain waiting to be discovered. As a rule of thumb, compare a company's PE to its expected growth rate. If the PE is significantly higher, the stock might be overpriced. Conversely, a lower PE could signal a great buying opportunity. Always pair this analysis with insights from the balance sheet, income statement, and dividend history. Together, these tools paint a complete picture of a company's health. Finally, let's talk mindset. Stock picking isn't gambling, it's a disciplined process. When you buy a stock, you're not just throwing darts at a board, you're making a calculated bet based on a compelling story. Ask yourself, why will this company succeed? Will sales increase? Are costs declining? Write down your reasoning in 2 paragraphs or less. If you can't explain it simply, you probably don't understand it well enough yet. Remember, even the best investors make mistakes. The trick is minimizing losses and letting winners run. Over my career, I've aimed to be right 6 times out of 10. Sounds modest, right? But those wins far outweigh the losses when you play the odds wisely. To wrap things up, investing is a journey, not a sprint. Focus on the fundamentals, stay patient, and trust the process. Use your unique advantages, whether it's your profession, hobbies, or local knowledge, to uncover hidden gems. And most importantly, keep learning. Every mistake teaches you something valuable, and every success brings you closer to your goals. Thank you for joining me today. I hope this video inspires you to take control of your financial future. If you found it helpful, please like, subscribe, and share your thoughts in the comments below. Until next time, stay curious, stay disciplined, and keep dreaming big.